The Indian steel market has been in a flux, facing challenges and opportunities alike with the new wave of global events, tariff announcements by President Trump adding further complexity.
Starting tomorrow, the United States will implement reciprocal tariffs on other nations.
Metal stocks have been under pressure since the announcement of the tariffs, but since Friday, the stocks have tumbled. On Monday, April 7th, metal stocks bled as Trump's tariffs coupled with China's stimulus plans weighed on investor sentiments. The Nifty Metal Index plunged up to 8.60%, hitting a fresh 52-week low, making it the top sectoral loser on that day. That said, metal stocks including Tata Steel, JSW Steel and SAIL have been in the spotlight for a few months before April, driven by Chinese economic recovery. On March 19th, steel stocks surged after the Directorate General of Trade Remedies or DGTR recommended a 12% provisional safeguard duty on select steel imports for 200 days. But why were such recommendations needed in the first place? What does it mean to Indian steel companies and how concerned should the metal industry be with respect to tariffs? Let's break it down. Welcome to Bottomline by Groww. I'm Radhika Bajaj. In today's episode, we dissect why steel companies have been under pressure, what has changed, and what lies ahead. The Indian steel industry has faced price challenges over the past few quarters due to weak global demand and increased Chinese imports. As such, steel realizations have remained under pressure, primarily due to weak demand, an influx of cheaper Chinese imports to India, and increased production capacities. Now, steel realization actually refers to the average selling price of steel per ton. Steel realizations have declined by an average of 15% in the last year as per analyst reports. For instance, Tata Steel's realization fell from 77,359 rupees per ton in Q3 FY24 to 69,493 rupees per ton. Similarly, for JSW Steel, it fell from rupees 69,900 per ton to 61,666 rupees per ton. The lower raw material and energy costs have provided some relief though for operating profit, helping to offset the decline in steel prices to some extent. However, the recent imposition of safeguard duties and an expected revival in steel prices have sparked renewed optimism. That is, a 12% provisional safeguard duty for 200 days on select steel products could trigger a positive impact on companies' profitability. Let's understand the broader story so far. India's steel demand has been growing at a strong pace over the years, consistently surpassing other major economies. In recent years, it has achieved double-digit growth, contrasting with demand contraction in most global markets. This robust domestic outlook presents significant opportunities for Indian steel manufacturers who are expanding capacities and enhancing value-added production. Despite strong demand and a steady expansion in domestic supply, steel prices in India have been on a downward trajectory over the past 2 years. In the post-pandemic period, steel prices peaked at 85,000 rupees per ton in mid-2022, but they've steadily declined to about 50,000 rupees per ton by March 2024. The downward trend has continued into FY25, with prices dipping below 50,000 rupees per ton, hitting a 4-year low. While the earlier decline was largely influenced by global trends, the recent price slump has been primarily driven by excessive Chinese steel exports on account of a real estate slump in China. In October of 2024, steel exports from China reached 11 million tons, a figure close to its previous peak of 2015. Back then, this flood of exports disrupted steel prices worldwide and affected the performance of steel companies, forcing India to impose anti-dumping duties in 2016 to protect the domestic steel industry. This time around too, declining steel prices have weighed on the sector's profitability since FY23. However, one positive outcome of these declines in steel prices is that the prices of key raw materials, coking coal and iron ore, have also come down during the same period. According to analysts, the cooling of coking coal prices, coupled with Indian companies' focus on cost reduction initiatives, had to some extent supported margin and profit recovery in the sector. Since last year, Indian steel producers have been advocating for control measures as they have struggled to compete with the influx of cheap Chinese imports. The Indian Steel Association, or ISA, which represents leading steel makers such as Tata Steel and JSW Steel, had urged the government to introduce safeguard duties, particularly after the US imposed a 25% tariff on steel and aluminium imports. The fear was that such US tariffs would increase steel imports into India, further exacerbating the pressure on domestic manufacturers. As such, the implementation of the safeguard duty has significantly impacted steel imports, leading to a 30% year-on-year decline in February 2025 as per reports. This in turn has contributed to a price rebound, with domestic steel prices rising in March this year. The steel price trend is expected to continue upwards, with China's real estate market showing signs of stabilization. As a result, the surge in Chinese steel exports could moderate going ahead, leading to a potential recovery in global steel prices. Post the announcement of DGTR, multiple brokerage firms have expressed optimism about the future of the Indian steel sector. Now, according to Nuvama, every 1,000 rupee per ton increase in steel prices is expected to impact FY26 EBITDA by 7 to 8% for SAIL and JSW Steel and 5% for Tata Steel, also 4% for Jindal Steel and Power. Similarly, Morgan Stanley has projected that if a safeguard duty in the range of 10 to 15% is implemented, it could lead to an EBITDA boost of 20 to 40% for SAIL, 15 to 28% for JSW Steel, 12 to 22% for Tata Steel, and between 6 and 15% for Jindal Steel and Power. The expectation of higher steel prices coupled with lower production costs could significantly improve the profitability of steel companies in the coming quarters. So what has helped steel companies pull through what's been a challenging period? While the outlook for steel companies is expected to improve, sustaining performance amid declining steel prices and lower realizations has definitely been challenging. Despite these headwinds, companies have successfully stabilized their margins and have actively planned capacity expansions to capitalize on future growth opportunities. How did they do it? To begin with, as mentioned earlier, one of the factors that have helped steel companies navigate the recent challenges is the decline in production costs. Iron ore prices have been on a downward trend since 2022, along with coking coal prices. Coal, which constitutes a major component of steel production costs, has seen its prices decline. While this reduction has provided some relief, the price of iron ore has slowly been on the rise over the past year, adding pressure on margins. Secondly, increasing exposure to value-added products. Another factor that has helped steel companies maintain a relatively strong operating margin is their presence in the value-added products portfolio, which has helped cushion margins despite a fall in realizations. For instance, Tata Steel's value-added products include automotive steels, galvanized sheets, pre-engineered buildings, and specialized solutions for construction and consumer durables. The company has also commissioned a new cold rolling mill. Similarly, for JSW Steel, value-added products include galvanized and color-coated steel, as well as specialized grades of steel for the automotive, oil and gas, and solar sectors. JSW Steel has increased its sales of high-end steel used in specialized applications such as transformer manufacturing. With 60% of its sales coming from its value-added portfolio, JSW Steel has been able to differentiate itself in the market and reduce its exposure to fluctuations in commodity steel prices. Jindal Steel too has been expanding its deliveries to the automotive and construction sectors, allowing it to tap into more profitable segments of the market. Thirdly, operating leverage strength. The current utilization across major steel companies is at a healthy 80%, which has improved the operational leverage. That is, several companies have taken strategic steps to secure raw material linkages, helping to lower costs. JSW Steel, for example, has commissioned iron ore and coal mines in Karnataka, Odisha and Goa, reducing its reliance on external procurements. Similarly, Jindal Steel has acquired 4 coal mines and ramped up production, lowering its dependence on expensive coal purchases from the open market. Additionally, investments in renewable energy have further contributed to cost savings, making steel production more sustainable and cost efficient. The same is reflected in the EBITDA margin. The EBITDA margin across companies has dipped in FY23 compared to FY22, but in FY24 it has stabilized to some extent. Similarly, in the 9 months ending December 2024, though the margins have dipped, the fall to some extent has been arrested thanks to the focus on value-added products and lower raw material costs. Let's take a look at the Indian steel industry's outlook. While the journey for Indian steel makers has not been too rough, they had to go through a challenging phase. But the prospects ahead are bright. India's per capita steel consumption in 2023 stands at about 93 kgs, significantly below the global average of 220 kgs. This highlights substantial room for growth and opportunities as the country progresses towards increasing urbanization and industrialization. The Indian crude steel capacity was 180 million metric tons at FY24 end, up 11% year-on-year. Ministry of Steel targets increasing it to 300 million metric tons by 2030 and 500 million metric tons by 2047. To achieve this target, 8% capacity CAGR will be required by 2030. All this bodes well for domestic steel companies along with their capacity expansion plans very much in place. In the past few quarters, steel companies have been ramping up capacities for both expansion and reducing their dependencies on raw materials like iron ore. Tata Steel, for instance, has announced a capex plan of 16,000 crore rupees for FY25. The company plans to spend 75% of its capex on capacity expansion in India, particularly in its Odisha steel plant project, and the balance in the United Kingdom. As such, in Q3 FY25, the company commissioned a 5 billion ton per annum blast furnace in Odisha. Another company, JSW Steel, for instance, has also been on a capacity expansion spree. The company had announced its capital expenditure for 3 years from FY25 to FY27. For FY25, the company had announced a capex of 16,000 crore rupees from its earlier announcement of 20,000 crore rupees. Of this 16,000 crore rupees, it has already spent around 11,000 crore rupees. This apart, another positive factor for Indian steelmakers is the Chinese government's recent announcement of a 5% GDP growth target for 2025, coupled with stimulus measures aimed at boosting its real estate sector and overall consumption. Additionally, China has initiated steps to restructure its steel industry by imposing production restrictions with an expected reduction of 50 million tons in output. If implemented, these measures could reduce the flow of cheap Chinese steel into global markets, providing structural relief to steel manufacturers worldwide. For India, this could mean less competition from Chinese imports to India and improved domestic pricing. With several structural tailwinds in place, including strong domestic demand, potential safeguard duties, recovering steel prices, and declining raw material costs, earnings prospects for Indian steel companies are looking increasingly positive. That said, global trade policies, particularly any tariffs imposed by the United States or retaliatory measures by China, will need close monitoring as they could influence the market dynamics. This is because, for one, the high tariffs on China imposed by Trump have majorly impacted the metal sector, given how China controls the supply and demand of metals. Also, China's focus is now shifting towards dumping steel where it is cheaper to export, as it is one of the most affected countries due to Trump's tariffs. Nonetheless, the overall trajectory for Indian steel players appears to be on an upward path, backed by a combination of policy support, demand growth, and operational efficiencies. What are your thoughts on this sector? Do you hold any steel stocks in your portfolio? And tell us, how have they performed? Share your views in the comments and subscribe to Bottomline by Groww for more such insights.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.